Historically, growth and value kind of traded off between different time periods, and academics for a while thought, value stocks were the long-term outperformer. But over the past 20 years, growth has really taken the baton from value and has been trouncing it recently. In fact, the Russell 3000 growth has fully doubled the performance of the Russell 3000 value over the 20-year period ending in 2023, outperforming it by 430 basis points annually. And we think there's a couple of really big structural reasons why growth has outperformed value over the past couple of decades and why it will continue to outperform value over the next couple of decades. One issue is related to style classification, and the second issue is related to accelerating innovation.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hello, everyone. I'm Jose Torres, your senior economist here at Interactive Brokers. Welcome to our podcasts. Investors are all too familiar with the current challenges that equity markets face. Recent data points to increased risk of a possible downturn, and hopes of the Fed promptly pivoting to a dovish stance have faded. Meanwhile, equity valuations are a little rich. The U.S. continues to scrutinize China's trade practices, and China's relationship with Taiwan is strained. Elsewhere in the world, the Russia-Ukraine conflict and the Israel-Hamas war threaten supply chains and the flow of energy commodities. But hope for equity investing exists, and today I'm thrilled to talk with Brad Neuman, Director of Market Strategy for Alger Investments. The firm is highly regarded as a pioneer of growth investing, and over its 60-year history has weathered a variety of challenging market conditions. Brad has an impressive background, including previously managing investments at Omega Advisors and Glenview Capital. Brad has unique insights into the power of innovation and, more specifically, how technology can help companies disrupt existing business practices and produce earnings growth that drive equity gains. In addition to developing market strategy at Alger and providing the firm's clients with timely guidance, Brad appears frequently on CNBC and has been quoted in Barron's, The Wall Street Journal, Bloomberg, The Washington Post, Institutional Investor, Pensions and Investments, and MarketWatch. Welcome, Brad. I'm really looking forward to chatting with you today. How are things in New York?
Oh, well, thanks for having me. I'm thrilled to be here. Right now, we're recording on a beautiful sunny day. All's well.
Terrific. So let's get straight into it. What do you think of the macro backdrop, especially as the Fed has shifted from foe to friend by appearing to embrace a dovish stance?
Well, I think there are certainly some challenges in the monetary landscape. So there's been sticky core services inflation. So that's services, ex-housing, food and energy. That's actually been trending up, which is not the way we want to see it. And that's causing the Fed to push out their easing from historic high interest rates. I think that's kind of the near term. And, we're also seeing businesses having intentions of increasing prices accelerating recently with the National Federation of Independent Bureau Small Business Survey showing businesses are maybe increasing prices on a more frequent basis. But I think that's the kind of the short term. And I think investors shouldn't get too caught up in the short term. I think the big picture is that the Fed funds rate of 5.5% is too high and it's going to come down. And I think there's a couple ways to look at that. First, the Fed itself says that the long-term rate should be about 2.6%. So that's a long way down from the 5.5% that it is currently. Another way of looking at this is that the current real Fed funds rate is in the high twos, about 2.7%. I'm just taking 5.5% less the current, as we're recording this, core personal consumption expenditure deflator, which is about 2.8%. So that 2.7 or so of real Fed funds rate is very high relative to history. The last time it was that high was 2007, and it was relatively brief. And the median since 1990 is close to zero, about 0.2%. So we're 250 basis points, maybe higher than we should be. And of course, if inflation comes down, then the rate should come down even more. So I think that's a good indication of why the Fed is looking to cut rates. And I think for investors, they should keep their eye kind of on the long-term ball, which is that interest rates will fall.
Terrific. And one thing that I've been watching is inflation is quite a tailwind for risk assets. Earnings per share, all else equal, if inflation is running at 3.5%, and you have revenues and expenses growing at that rate, then that's a pretty good tailwind for equity performance going forward, particularly against the backdrop of a Fed that's going to be cutting, like you said, Brad. Now, what opportunities are you seeing in small to mid cap areas? Are you favoring growth or value tilts in this environment?
Well, so we were just talking about interest rates and the potential impact it has on equity prices. So interest rates should have, in general, some impact on all types of stocks because interest rates affect the cost of capital and the discount rate with which you discount back future cash flows. But it seems that interest rates are most impact small growth stocks. And maybe the reason for that is because small growth stocks are kind of long duration assets. So just like interest rates impact, say, a 30-year bond more than a 1-year bond, they may impact small growth stocks more than, say, large value stocks where the cash flows are more current. So what we've observed in the past couple of years is that there's been higher than a minus 80% correlation between small cap growth stocks, the Russell 2000 growth, and 2-year interest rates. So, if you look in the declining interest rate environment from 2018 to 2021, you saw small growth outperform. Then in the rising interest rate environment from 2021 to 2023, you saw small growth underperform. And more recently, it seems like small growth is getting its sea legs back as rates have stabilized, at least stopped going up significantly. So I would say that as interest rates come down on the short end, that may benefit these long duration small cap growth stocks like the Russell 2000 growth. And I think there's 3 other reasons, if you want to go into it, or at least a couple other reasons why we like small cap growth stocks, and that's valuation and fundamentals.
Yeah, absolutely. We've been looking at valuations for small caps, and they look pretty historically attractive relative to large caps. The last couple of years, seen big driver of outperformance coming from the large caps. Now, as a growth investor, what are some of the evergreen reasons for investing in growth? And separately, are there any timely developments that make this a particularly appealing time for growth investing?
Historically, growth and value kind of traded off between different time periods, and academics for a while thought value stocks were the long-term outperformer. But over the past 20 years, growth has really taken the baton from value and has been trouncing it recently. In fact, the Russell 3000 growth has fully doubled the performance of the Russell 3000 value over the 20-year period ending in 2023, outperforming it by 430 basis points annually. And we think there's a couple of really big structural reasons why growth has outperformed value over the past couple of decades and why it will continue to outperform value over the next couple of decades. One issue is related to style classification, and the second issue is related to accelerating innovation. And if you want me to go into detail, I'm happy to do that.
Yeah, we're happy to hear you, Brad.
On the topic of accelerating innovation, value stocks, when you buy a value stock, you're typically buying a stock that's cheap and you're hoping that it's only temporarily cheap. It's going to increase in valuation. But if innovation is accelerating and change is accelerating, some of those value stocks may simply be value traps. They may be victims of change. So here I'm thinking about things like newspapers or coal stocks or companies and industries where they look cheap, but they were cheap for a reason. The world changed so dramatically, such as in media or energy, that these companies' earnings actually degraded and they were kind of like melting ice cubes. And so what we're seeing, I think, in the past couple of decades is that innovation is accelerating. So we're all familiar with Moore's law. I think that the number of transistors on a chip is doubling every couple of years. And that's one of the driving forces that's making these new technologies diffuse through society much faster. So, for example, it took many decades for the washing machine and cable TV in the 20th century to reach 50% penetration of American households, whereas the internet did it in 14 years, social media did it in 9 years, and tablets did it in 7 years. And that's driving increased disruption. So it took a quarter of a century for the Microsoft operating system and Office suite to reach 1 billion users. Took Google search only 12 years. Facebook and YouTube did it in under a decade. TikTok did it in 5. And we think ChatGPT may do it in just a few years. I think they're already up to about 180 million users. Going forward, I think this innovation is going to accelerate. Artificial intelligence is actually growing much faster than Moore's law. We think it's doubling possibly every 4 months instead of every couple of years. And so for context, a 6-inch plant growing at the rate of Moore's law would be 16 feet tall in a decade, but growing at the speed of AI would reach the moon in a decade. So these are very significant differences in rates of growth.
You make a good point, Brad. Earlier, you were talking about how growth has really outperformed value. And when you ask regular investors what their major holdings are, there's been a significant shift over the last 20 years. Back then, folks had a lot of energy, they had a lot of financials, they had a lot of industrials. And today, to your point, it's all about the tech stocks.
Yeah, and that has, I think, a lot of significant impacts on the overall index. Maybe some investors aren't super familiar with. So, for example, I think that there is a lot of asset allocation between, stocks and bonds and other assets based, say, on traditional valuation metrics of the S&P 500, for example. So maybe people look at price to earnings multiples, and that influences their asset allocation. Well, as you mentioned, when there are more growth stocks and the composition of the index changes, that has, I think, maybe trillions of dollars of implication for asset allocation because valuations have now changed. So these large tech stocks, I think, should trade at higher price to earnings multiples than the leaders of the S&P 500 decades ago. And there's several reasons for that. They have higher returns on capital, and importantly, they have higher free cash flow conversion, meaning for every dollar of earnings, they generate more in free cash. So I think there's a lot of implications of the fact that these indices are loaded with more growth in tech stocks, as you mentioned.
What's the shift in dividends, because back in those times, 2 or 3 decades ago, a big chunk of investments their returns were driven by the dividends. And now we're not seeing that. It's more about share repurchasing. And to your point, a lot of innovation and new products and services.
We have seen Alphabet institute a dividend and Meta, of course, buying back stock and returning cash to shareholders. So it is on the come. And I do think that some of these large tech companies, because they have such high return on capital, the beauty of that is that you can grow and give back to shareholders. Whereas the companies of decades ago, with their very low returns on capital, they kind of had to make a choice. Either we're going to grow, in which case, because of the low returns on capital, we have to invest a lot in our business, or we can give it back to shareholders. And it's possible that some of these large tech companies may be able to give investors their cake and let them eat it as well.
Yeah, absolutely. We saw also during that time, before we move into AI, a lot of firms, they had too high of a dividend payout ratio, and they lost market share because of that, especially the big department stores. When you think about the big telecommunication providers, T-Mobile came in, took a ton of market share. Amazon came in, gained a lot of market share as well. Now let's talk a little bit about AI. Everyone kind of knows what the large cap companies are doing. We followed it a lot on the news, big headlines. Talk to me a little bit about small and mid cap growth companies benefiting from artificial intelligence.
Well, first, I'll just set the stage since we just completed about half of the S&P 500 earnings for the first quarter. One big takeaway is how much these companies are investing in AI. Now, the large cloud companies, they're now increasing their CapEx investment in cloud or these big data centers to support AI growth 35% year on year. So they're spending over $200 billion and growing very rapidly to provide these AI services. Now, those are the big companies. Clearly, some of that spend goes to other big companies, the NVIDIAs of the world, the big semiconductor companies of the world. But we're seeing benefits of that spending in smaller mid-cap companies. So, for example, Vertiv is a company that provides some of the cooling systems and other maintenance and technology to data centers, because the new chips in these data centers generate a lot of heat. And as the chips become more powerful and as the data centers grow, there's more of a focus on how to maintain and cool these data centers. Now, Vertiv just reported, well, they're seeing a huge surge in their business, big surge in orders and sales. But they mentioned specifically that they're seeing artificial intelligence as a big driver for their business. Again, because the chips are changing data center growth. And so that's a way that is filtering down into a smaller company. Additionally, we think there's going to be a strain on power. So data centers use about 3% of US power now. And because of artificial intelligence and the growth of these data centers, and as I mentioned, the chips that go in the data centers that use more energy, we think that 3% is going to go to about 10% by the end of the decade. And that's going to benefit the companies that build and maintain power grids. There are some smaller companies that do that. A company like Quanta would be a good example. And then finally, again, within the data center, there's interconnections that are very important between the servers and to reduce energy or make the energy as efficient as possible. So these interconnections are quite important for high bandwidth and speed, reliability, and scalability. And so a company like Amphenol, which is in the mid-cap space, would benefit there. So there are companies that both do the enablement and infrastructure of AI and companies that adopt AI to make their own businesses better. But that's where it's trickling down to on the mid and small cap realm, rather than, yes, you don't have companies that are platform companies that are providing cloud-based services, but they are integral to helping these large companies provide the services.
Shifting to the election, any opportunities or risks with the election coming up and the possible shift in administration? Which sectors do you think will benefit from each outcome?
Well, I think the stock market's likely to be increasingly volatile as we head into the election. The market historically often sees weakness into the election and then rallies upon the certainty of the election. So I wouldn't be surprised if volatility picked up here. It's probably more than likely that we're going to have a split government if we do. In other words, if the Senate and the House and the executive branch aren't all lined up, then that means that not that much consequential can get passed. So I think that would be the best case for markets, and it's probably the most likely case, although we'll have to watch it carefully. But I think our major message on the election is that investing in policies doesn't work. So if you looked at the 2016 election, if you had invested in domestically oriented companies based on the quote unquote America First policies that were enacted back then, like corporate tax cuts, those domestically oriented companies actually underperformed in the first year and kind of performed in line over 2 years. So it wasn't a great investing approach. Similarly, investing in renewable energy companies, which was one of the cornerstones of the Biden administration after the 2020 election, that didn't really work. Over the 2 years after that election, those stocks significantly underperformed. So, we could rattle off a few industries that would do well if in a Trump win or if Biden prevails. For example, a Trump win would probably favor traditional energy and hurt renewable energy. Trump win would also probably help big banks vis-a-vis lower capital requirements. But I think it's probably not a great idea to try to invest along those policy lines.
And you make a really good point, Brad. Sometimes Washington spends money and, the benefit isn't really that obvious.
Exactly.
Are there any investment themes that you would like to discuss overall?
Well, so we already talked a lot about AI and the AI adjacency, so I won't go through any of that, but just some other areas that we like. We really like aerospace parts. So these are companies that make replacement parts for the most part that go into commercial airlines. And there's 3 reasons why we like that space. First, there's strong secular growth in that industry. So you've got an aging fleet of aircraft and you've got increasing traffic, particularly as emerging markets like China begin to travel more. So strong growth, number 1. 2, a recovery still after COVID in long haul travel. So that's like transatlantic, transpacific type flights. 3rd, there's really high barriers to entry for this segment. So these are companies like HEICO and TransDigm, and they provide FAA-approved parts at lower cost than the OEMs do. And most of the parts that they provide, they're the sole provider. So they've got some pricing power there and limited competition because they're FAA approved. So we think it's a great business that has some secular and cyclical growth. Maybe one other area to highlight is private market asset managers. So these are companies that allow individuals to invest in private equity or private credit. So that they're public stocks that trade on stock exchange, but they allow their customers to invest in private markets. So these are companies like Hamilton Lane and Stepstone. We think it's a really strongly growing market because the allocation for the kind of the U.S. mass affluent investors in private equity is only about 3%. As compared to 28% for U.S. institutions. That's one of the reasons why Bain projects that individuals investing in alternatives, that AUM may go from $4 trillion in 2022 to $13 trillion in a decade, which would be 12% growth. And these companies are providing a lot of innovations like increased liquidity and lower minimums to allow individual investors into that asset class. So we think that's an interesting area as well.
There you have it, ladies and gentlemen. That's Brad Neuman, Director of Market Strategy for Alger Investments. Brad, it was a pleasure having you here. We're so grateful, and thanks a lot for your time.
Yeah, thanks so much for having me.
Ladies and gentlemen, thanks a lot for tuning in to this episode of Interactive Brokers IBKR Podcasts. Feel free to download our podcast on your favorite podcast channel, and I'll see you next time. Thank you.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com. financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRQuant.com.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.